investors, how much do you know about the real estate market in Poland?
Chances are it has flown under your radar. And that is why we flew in from Poland to present you Dom Development, Poland's leading residential real estate developer. We are bullish on this stock and we are issuing a buy recommendation on this stock with a target price of 272 Polish zlotys. This is 24% upside on the stock from the close of 30th April. Ladies and gentlemen, did you know Poland is one of Europe's fastest growing economies? It is currently experiencing a real estate boom. Check this, prices have doubled in just 6 years. And Dom Development is the company cashing in on this boom. Founded in 1996, Dom Development is a residential developer specializing in multifamily housing. It has delivered over 50,000 units to date, and impressively, the company has a track record of 18 years of dividend payments. Operating in 4 of the 6 biggest housing markets in Poland, Dom Development posted 3 billion PLN in revenue. This is slightly below 1 billion US dollars. Dear investors, we see 3 reasons why Dom is a compelling investment. First, well positioned to sustain market leadership. Second, there's a structural housing gap which benefits Dom Development in Poland. And third, it has a strong, robust development pipeline. We conducted over 30 interviews with direct customers and competitors of Dom. And now let's delve into its business model.
Dom operates fast. We witnessed that firsthand when we visited one of their construction sites. At the time this picture was taken, over 30% of the site was already sold out despite the early construction stages. This is a result of an integrated business model that relies on strategic land acquisitions with permits and managing construction through a mix of internal general contractors and external subcontractors. This is further strengthened by value-added services like mortgage consulting and turnkey apartments. The key to Dom's success lies in its efficient land and its resilient client base. The company's land bank is capable of supporting a 5-year project pipeline, and its focus on the premium segment gives the company a pricing flexibility that then allows them to manage rising costs.
Now, please think about this. Poland is facing a structural housing gap. Home ownership isn't a financial decision, it's part of culture shaped by the country's history. And yet, Poland continues to have one of the highest overcrowding ratios in Europe. Yes, this is the market that Dom Development operates in. Adding to that, Dom's key cities are expected to grow, defying the national trend. Furthermore, influx of 2 million Ukrainians due to the ongoing war has further accelerated urban migration. So the result of this, a housing market with sustained and urban demand. But wait, demand alone isn't enough. Affordability will be the key. With inflation now cooling down, interest rate cuts in second half of 2025 will unlock purchasing power. On the other hand, our analysis backed by interviews with industry experts, including CEO of Dom's direct competitor, highlight rising costs will squeeze margins. In the meantime, the short-term sentiments on the Polish market also remain mixed. While the new offers from the developers are rising, the slower demand in 2024 has pushed the available offers to a 5-year high across the biggest markets. And yet, the rising construction permit signaled renewed confidence for the future. So the answer, why does Dom thrive in this environment, or how does they thrive in the environment? The answer lies in its strategic land bank. What truly sets the company apart is the prime location and quality of its asset. The premium portfolio secures a distinct competitive edge, reinforcing both our first and third investment thesis. But then, strong positioning would mean nothing without execution. Even during challenging 2024, Dom not only outpaced its competitors in sales volume, but speed, once again showcasing its operational excellence. Now, as the market consolidates and the weaker players struggle, Dom is in prime position to benefit from this opportunity, backed by its strong balance sheet and high cash reserve. Now, let's see how all this flows into our financial statements.
Dom Development continues to deliver consistent revenue growth supported by healthy margins. To forecast this trend, we analyzed projects dating back to 2012 and extrapolated construction pipeline, adjusting for pricing dynamics across cities. Profitability is expected to soften gradually due to rising land and operational costs, yet we still believe it will remain at healthy double-digit levels. Nonetheless, strong fundamentals remain intact. Underpriced structural demand drivers like urban overcrowding, rising migration, and improving financing conditions support ongoing sales momentum. These trends allow Dom to partially absorb upcoming cost pressures and maintain a stable growth path even in a changing macroeconomic environment.
This resilient performance is underpinned by DOM's disciplined financial management. Companies' low net debt levels and stable cash reserves protect against volatility, giving it a reliable foundation for operation. This strict capital management not only reduces reliance on external financing, but also shields the company from potential economic downturns, allowing it to maintain growth without compromising stability. Additionally, the company presents strong value creation ability. Its consistent dividend growth and top-tier ROE reflect prudent capital allocation and long-term vision. By balancing profitability with a commitment to reward investors, the company has built a track record of delivering attractive and predictable capital returns over time. At the core of this financial strength lies DOM's unmatched operational efficiency. Its market-leading cash conversion cycle allows for quicker project turnover, lower financing needs, and faster investment. In an industry where execution matters, DOM is perfectly positioned to grow sustainably, seizing opportunities as they arise while minimizing risk.
And this is shown perfectly in the growing alignment between DOM's strategy and sustainability. On the environmental side, the company's more than doubled its use of renewable energy, simultaneously decreasing greenhouse gas emissions. This supports company targets and results in an overall better ESG risk score in the region. Socially, DOM designs accessible, livable 15-minute cities. Internally, it leads the sector in employee retention and has above average levels of gender diversity at senior levels. Governance is also evolving. The appointment of an ex-chief ESG officer as the new CEO and the first female CFO signal that ESG priorities are starting to influence leadership at the highest level. That said, there are still gaps. Full life cycle analysis is still pending, ESG-linked KPIs haven't been disclosed, and DOM has yet to adopt green building certifications. So overall, the ESG impact is mixed. However, one area stands out, and it's DOM's regulatory proactiveness. We reflected that in increased SG&A costs, while also recognizing the long-term benefits of regulatory risk mitigation. Now, having considered ESG, let's crunch the numbers.
We value DOM using a 50-50 blended approach of DCF and relative valuation, allowing us to capture both the company's long-term intrinsic value and market perspective. Key factors considered in DCF model include DOM historical project trends, current land bank capacity, and a detailed pipeline projection. We applied a WACC of 9.4%, where our cost of equity includes a 40 basis points premium for DOM's low trading volume, while our cost of debt is a yield to maturity of DOM's bonds. We determined a terminal growth rate of 2.7%. Even with our conservative revenue estimates and a cautious margins assumptions, our DCF analysis shows a 25% upside, leading to a target price of 275 PLN per share. To stress test our valuation, we conducted a sensitivity and a bull and bear case analysis by varying key assumptions. In our bull case, we also assume the issuance of green bonds, leading to a 10 basis points reduction in cost of debt.
We have also considered price to earnings and EV to EBITDA multiples in our valuation. We built two peer sets, local Polish peers and regional European peers based on similar real estate business models. However, for the final price target, we have only considered Polish companies due to specific conditions in Poland. Dear investors, this company is trading at an unjustified discount and presents a strong re-rating potential. DOM Development's based on price to earnings, DOM Development shows a 22% upside, whereas based on EV to EBITDA multiple, it shows a 23% upside. In our sum of the parts valuation model, we have built 3 years of deliveries of the company and have valued them separately. This model also confirms our other valuation methodologies and shows a 22% upside.
Despite our strong recommendation, we have identified 3 key risks. First, inflation and a sustained trend of high interest rates may weaken residential sales and squeeze developers' margins. Second, uncertainty around new Spatial Planning Act poses an additional government risk. Third, the Ukraine war threatens migration, capital, and labor flows. Dear investors, in Polish DOM means home. But to us, it stands for dominance, opportunity, and momentum, the core drivers of our buy recommendation. Now, from Team Poland to the world, we open the floor for any questions you may have. Thank you.
Could you comment something more about the interest rates? Because at the end of the day, in real estate and interest rates are highly related.
Thank you for your question. My name is Aniket, and I would be happy to take your question. Jade, if you could move. Okay, the slide is already here. So our assumption about falling interest rates stems from the FRAs. The 6v9 FRAs show that there would be about an interest rate cut of about 100 basis points in the next few months. Additionally, the commentary by the head of National Polish Bank and the monetary chairman suggests that interest rate cuts could come in as soon as May if the inflation remains in control, and the inflation has been falling. So when the interest rates falling down, the demand would be unlocked in the market. Thank you.
I mean, even though tariffs do not apply to you directly, but to Europe it might apply, and that could have an impact on inflation in the future. Do you think that that could have an impact on your pricing, on your valuation?
Sure. So my name is Anastasia, and happily take this question. So we considered the impact of tariffs by two things. We first of all looked at the places where DOM sources their materials, and all of them are in Europe, so there's no direct impact of tariffs on DOM's operations. And second of all, we also spoke with DOM's ex-CFO, who also identified the potential broader impact on tariffs on the economic situation in the world. However, we see no direct impact and think that people may still buy flats with DOM as an inflation hedge.
Okay.
I had a question on affordability of the houses. You indicated that there is a significant gap. I was just wondering how that compares to the percentage to the people that can afford the houses themselves. Given that when I look at the chart, it shows the number of units sold have been coming down over the years.
Thank you, Emma, for this question. I would like to bring your attention. So definitely affordability and home affordability is a problem in Europe, but in Poland, the story is different. If you look at the orange line here, you see 11. What this means is the price to income ratio, which means that how many years you need to work to afford an apartment in Poland, is still one of the lowest. So while if you would be in any different European country, the affordability would still suffer, but in Poland, it is still one of the best places to afford an apartment. Similarly, you see the price to income ratio. This is another ratio we analyze to understand whether people are better off renting or they're better off owning. And if this ratio is lower, it basically means you are better off. You can afford your own apartment and own your own apartment. And here as well, we see Polish economy and the Poland as a general is more affordable. So this will unlock more demand, and DOM development is perfectly positioned in this case.
So maybe just a quick follow-up. So how does that explain the decline in the units sold over time?
Okay, I would be happy to take that question. So we saw that in 2023, there was a mortgage program run by Polish government, and that mortgage program offered a 2% subsidy to the buyers. Unfortunately, the program was abruptly ended at the start of 2024, and hence there is a deferred demand in the market where the customers are waiting for interest rates to go down or the mortgage rates or the mortgage program to come up. However, recently the government has clarified that the mortgage program would be coming to a secondary market. So now that the market knows that there is no mortgage program and interest rates would come down, we believe that this demand would be unlocked for the growth.
I have a question on your DCF analysis. So this is a developer which is highly dependent on the state of the economy, and you use beta of 0.6. I'm interested in how you came up with beta of 0.6, and obviously there's different ways of coming up with beta, but how sensitive is your recommendation or target price with potential change in beta of the stock?
Thank you for this question. My name is Zosia, and I will be happy to answer your question. So basically, to calculate the beta, we conducted 4 different methods of calculation, and we opted for the weekly 5-year regression of DOM versus a VIG index. And basically, it gave us like a number of 0.62, which we believe basically reflects the best company's position when it comes to the risk profile. It is right now bearing. And when it comes to the sensitivity, how we analyze it, we conducted a sensitivity based on the changes in our revenues and also as well the cost, as well as the WACC and changes in the growth rate.
You mentioned a terminal growth rate, I guess, of 2.7. I mean, many assumptions. I mean, that's an important assumption. Could you support more that information and what impact will have on your price if that is not correct? Actually, you had a table that showed that, but could you develop more on that?
Thank you for this question. So basically, we conducted an analysis and a terminal growth rate was calculated using key value driver formula by multiplying a RONIC of 10% and reinvestment rate of 28%. Based on that, we calculated a terminal growth rate of 2.7%, which is basically roughly about a long-term inflation of the interest rate in Poland of inflation of 2.5%. So it is slightly above 0.2%. Which basically is a really conservative approach. And we also conducted a sensitivity looking at the changes which will affect the growth rate which will come down, but we still believe our terminal growth rate is really low and reflects our conservative approach to the whole DCF and whole the evaluation we conducted for DOM development.
Excellent.
Can you talk about their market share and how they are compared to major competitors?
Okay, thank you for the question. I would happy to take it. When we see about the market share, DOM Development is one of the biggest real estate developers in Poland with about 10% market share. Additionally, we spoke to an industry expert and CEO of DOM who highlighted that in real estate, achieving a 15 to 20% market share is considered a luxury, and very few or no developers in Europe have this market share. So we believe in our forecast period, DOM would slightly expand its market share in the cities that it is growing, including Wrocław and Kraków, and then it will continue to grow with the market. Thank you.
And what about how does it compare to its competitors? How is it positioned?
So if you talk about DOM's positioning in the market, it is placed number one in three of the four markets that it operates in terms of the sales volume during the last year. And we see that this trend would continue. Now, talking about the competitors are scattered around both bigger markets, including the top 6 cities and the smaller market. And in this case, DOM gets a clear advantage being in the markets that are expected to grow.
Just to follow up on that, we actually prepared a more visual slide to illustrate how the markets work in our land bank analysis. So we can see that there are competitors of DOM that are actually scattered across many smaller cities, but we can see the key hubs where DOM operates, and these are the most profitable cities with upward population growth rates.
Are there any risk in accessing land in your country? Any regulatory risks? I've seen other cases in other countries where companies used to have a good access to land, but due to changes in regulation, they have done pretty bad.
Sure, thank you for your question. So basically, we see a regulatory risk, which is basically a government risk, through the introduction of new Spatial Planning Act in Poland. Basically, this new Spatial Planning Act will oblige somehow developers to somehow introduce their permits and also like the available plots and adjust it to the permits they will be receiving. So basically, the new Spatial Planning Act was announced not so long ago to be set it until the end of this year. However, due to the high challenges when it comes to each municipality to introduce this new Spatial Planning Act, basically there is a risk that this new Spatial Planning Act will be even more prolonged and might also affect the delays in the projects and also somehow close the possibility for new developers to also access the new projects as well.
In terms of competitive landscape, how are they positioned in terms of like their selling price per square feet, or like are they more like a luxury focus or more like mass market? Can you comment on that compared to other competitors, or is it really like a homogeneous market?
Okay, thank you for your question. I would be happy to take that. When we look at the average transaction value of DOM development, it is about 10 to 15% higher than the average market transaction. But it is important to note that they're not a luxury developer. They are in the premium segment, just above the upper standard. And that also shields them in a way to an extent from economic downturns, because their buyers are generally wealthy and better off than the average person in the country.
I noticed in your relative valuation, you opted to exclude other European peers. I was just wondering what the rationale was to exclude them and just look at Poland peers.
Sure. Aniket, could you please switch to relative valuation summary? And I can talk about it. Why we excluded them is because we see that a lot of financial differences between European peers and Polish peers. Poland is like a booming economy right now. The price per square meters are booming. Margins are at all-time highs. However, Europe has already passed this phase of big real estate cycle and boom of prices. So valuations are not really comparable, as well as the size of companies were not comparable. We used a specific GPR framework where we were trying to look for developers that really match the growth, profitability, as well as the risk profile. So this specific thing was not found. So we wanted to be more conservative and just use very local Polish peers in the valuation.
Is there any risk of other European developers or global developers entering into the market? Are there any regulations, or could that be a long-term risk for the company? If a major, like a global European competitor enters the market?
Okay, so to look at this, we have seen recent trends in the market where we have seen foreign investors from Germany investing and buying companies in Poland. However, given the market-specific nature of the market of Poland, as well as the know-how of the industry is very important in construction, as well as the permitting process. So in that case, we see that there is a risk, but it could be easily mitigated because the foreign companies would not have the know-how or the expertise or the connections or even contractors to execute projects as effectively as DOM does.
I may add to that. Polish market is currently having a very large growth in construction and labor costs, which is also an additional barrier to an European competitor entering the market.
What are the main drivers that are helping the growth in Poland, and what are the risks of those disappearing?
So I'll take the first part of the question and maybe my colleagues will follow up. So we identified the structural housing gap as the main driver of demand in Poland, and that is from reports from JLL and McKinsey. The structural housing gap in Poland stems from the fact that Poland used to be a centrally controlled economy. So a lot of the housing stock that is currently available is outdated. People live in overcrowded households. Right now, the average number of rooms per person in Poland is 1.1 as compared to 1.7 in Europe. So we see that there's a lot of room. People are getting higher wages. The economy is growing and they will want to move out to their flats. And on top of that, there's the home ownership rate, which signals that people actually prefer owning their home over renting. So we believe that the new generation of wealthier Poles will be moving out of their houses and buying apartments, which is the key driver in our analysis.
And the risks for that?
To add on to the risk, we see that there is a war going on in Ukraine that could cause, if it spills to the Polish border and extends, there could be an outflow of capital as well as migration outflow from the country, and this could dampen the demand. But the probability of such risk happening is very low, given that Poland is part of strategic alliances like NATO and EU. So we don't see a big negative side in the long-term drivers slowing down.
And why do you think all those positive things are not reflected in the multiple and it's trading at a discount?
Definitely, yes. Thanks, Rodriguez. If we go to the slide, why the stock is undervalued, there are two major drivers that I'm seeing. First one, let's look at the second one first, because that is more important. The market is currently swapping long-term tailwinds with short-term uncertainties. As we talked about mortgage programs, there were mortgage programs that would affect residential developers in the affordable segment. But remember, DOM development operates in a premium segment. So while the market was punishing the developers in the affordable segment, we see that DOM development was unfairly punished and its multiples were trading lower. However, DOM development is resilient to these government policies because it sells to a higher and more premium client base, which is more affluent. So they don't rely on the mortgage subsidies. So that's the first thing. Market is swapping these short-term uncertainties and punishing DOM. The second thing we see is that market is clearly not seeing that DOM development is ready for yet another record year. For the last 2 years, the company had record number of units sold, and based on current projections, it is definitely going to be another record year if all goes as per plan and without any uncertain risk. The stock is already up 20% year to date, by the way. So you have potential. We see another 20% potential on the stock. So it's not that market is not recognizing. It's just you gotta jump before it's too late.
I think he didn't quite talk about the valuation though that he asked about. Like, why do you think it's undervalued or compared to peers?
Time. Let's talk later.
And in a world of competitive nature, the winner of the 2025 CFA Institute Research Challenge is Kozminski University.